they're probably going to make more money than me in the short term, but I'm also lower risk and I can sleep better. And that's all it came down to at the time. It is very difficult sitting in an LP. Like I didn't invest in any floating rate bridge loan deals, but over 90% of anything I saw in the pipeline for a couple of years, 20 to 22, if I want to do anything, it had to be that. And it just puts you on the sideline. It's very frustrating, but you have to be disciplined.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast YouTube series, Real Estate Market Watch, current events through a real estate lens. Right, so this is going to be the first show of 2026. And so I'm delighted to bring you an old friend, actually. I've known Jeremy Roll for quite a few years now. And he is unusual in the sense that he is a professional passive investor. Oh my goodness. Jeremy he doesn't use this term exactly, but he's a data junkie. He spends a lot of time analyzing markets, data, and what's going on in the industry and stats and finance channels and all kinds of things. So he's very knowledgeable. He's a very conservative investor, which is probably one of the reasons he and I get on so well, because so am I. So our conversation today is going to reflect on lessons learned from the last few years and what happened in 2025. And we're going to give a little look at 2026. There's a lot of very practical insights and thoughts that Jeremy shares with us or with me on this show. So I think you're going to find this to be an interesting perspective to kick the year off with. If you have not already done so, please go to GowerCrowd.com. You'll find a show notes page with Jeremy, where I'll include all kinds of links to him so you can learn more about him, as well as a summary of this podcast in written form and access to the podcast and YouTube channel. But while you're there, also, please subscribe to my newsletter. It's totally free, and you can always unsubscribe, right? All there at GowerCrowd.com. Okay, let's get on with it. My old friend, Jeremy Roll, coming right up. Jeremy, how nice to see you again. Happy New Year again. We were just chatting about whether or not it's already too late to say that. Anyway, thanks for joining me.
Thank you for having me. Appreciate it.
Always a pleasure to see you, Jeremy. All right, so why don't we just start off with, let's chat about, what assumptions, let's talk about 25 and 26. All right, and let's look back first at 2025. What assumptions, Jeremy, about commercial real estate you think were exposed or broken in 2025?
I think, first of all, I think that survive till 25, which was a huge mantra going on from the previous years because of a lot of the adjustable rate mortgages, I think that broke completely. And frankly, I think it may even broken in 24 when people realized that it wasn't 25, was going to have to be beyond that. Another thing that broke was the expectation interest rates. I think a lot of people expect interest rates to be lower now than they are, like by this time. And I don't know whether it was an expectation or honestly a hope, because the hope was there that it was going to save some deals, and it just hasn't happened to the same degree that I think a lot of people were hoping for. I think that 25 was also an interesting year in that it broke predictability to an extent with tariffs and the cost of goods and inflation. And so, for someone like me, who's more of I look for predictability in investing, that was really a tough year to go through, to watch a lot of that uncertainty. And frankly, with like the two extensions of tariff deadlines, and that was just impacting the 10-year. It was impacting potential GDP. There was front running of purchases in the economy. There's all kinds of stuff going on. So it was a fairly complicated year. And now, 26, we're looking into elections coming up this year, which I just had a conversation with a very good friend of mine, and he's already predicting that, Trump has already started, where Trump is just throwing all these new policies left, right, and center. He thinks it's because of the midterm elections. And we may see more of that, which is all kind of effectively forms of stimulus to keep things propped up. So now there's that question mark is, okay, well, if you're trying to just look at history and to figure out what's going to happen in the future, there may be a lot of that coming up that's unpredictable as well. So we'll have to see.
Yeah, unpredictable. That's kind of the thing, isn't it? Let's revert back to interest rates. So why do you think interest rates are not as low as people expected?
Yeah, I think economic growth continued, and I think the Fed is trying to be objective about, to a degree, about what to do with interest rates. And I think the economic growth continued to be stronger than a lot of people expected, I think. And in fact, if you looked today, there was unemployment numbers, and now the odds of an interest rate cut in the next meeting are going down again because the numbers were stronger than expected. And, so it's obviously a dynamic in that it's constantly changing. But I think that was one of the main reasons why that occurred.
Yeah, but the Fed only controls short-term interest rates, don't they?
I
And those
mean,
have been coming down.
yeah, that's true too. I think that, yes, I totally subscribe to the reality. Objectively, they only control short-term interest rates. But I do think the long-term interest rates react when the short-term rates change. Now, there's other expectations we could talk about. There's how much demand is there for longer-term treasuries, right? There's the future outlook for inflation. And actually, we should talk about that too. That is one of the contributors in 25 that some people believe caused the 10-year to stay higher than it would have otherwise. Um, it's that the long-term, both potential lower demand for treasuries, which would imply higher interest rates, combined with the potential for higher inflation for longer, which would also imply higher interest rates. And then you have this other factor that we could spend a lot of time on if you want, which is, the future of the US, right? How much do investors need to be compensated for the risk of holding a treasury long term with the amount of debt that we're taking on?
Yes,
Um,
it's interesting, Seth. I'm going to jump in because this idea I hear floated a lot. I actually covered it extensively last year after Liberation Day and some of the subsequent stuff that went on. The
mhm.
impact on the dollar's position as what is called exorbitant privilege
Right, right.
that we enjoy here, and we've covered that a lot over the last few months, and I've been looking at that a lot. But I always wonder, and actually I asked Ken Rogoff this, right, Professor Rogoff in my one of my holiday podcasts. What is the timing for that? I mean, I think that what happened, my sense of what happened was that everybody reacted to the tariffs as though it was going to have dramatic, immediate impact. And what's happened over the last 12 months, almost 12 months, is that there's a realization that, yeah, sure, there's an impact, but it's not immediate. This is something that's not going to happen maybe for years yet. It may outlast, the impact may not be felt until after Trump turns out, right, in 3 years now. So shouldn't we just continue business as normal? Really, nothing's changing.
Well, there's a couple of things to consider with that. First of all, I've read some articles that were projecting that the impact will be felt actually as of Q1 of this year. And the reason for that is because, as I mentioned before, there was a lot of front running of inventories on the wholesale side and a lot of imports. And I think that a lot of people now have run some numbers to show that we've worked our way through a lot of that finally. And now you're just starting to get purchases on the wholesale side that are at that elevated level, which therefore has to be pushed through to the consumer, right? So I think a lot of that was staved off for a while, but that can only be held off for so long. So we'll have to see what happens in 26 with that, right? And then there's another factor, which again, not to complicate things, but there's currently judges ruling on whether the tariffs were legal. And Trump has also suggested that there's workarounds and other ways to approach it. We don't know if that's true, if it would even be tried. So there, uncertainty continues because imagine if they have to unwind all the tariffs. I'm not an attorney or any of that. I don't know how that works. Refunds to the countries. There's a lot there, right? But I will say this. The thing that we can take away is that when there's uncertainty in the face of an actual country and from an investor's perspective, there's more risk, right? It's just that simple. So that would also imply that the 10-year and longer term treasuries could stay higher for longer as long as the risk remains or the uncertainty remains.
Right, but as soon as it stabilizes, commercial real estate finds its new equilibrium level and business takes off again. I mean, right?
Is it that simple?
Well, I don't know. I mean, I entered this industry in the 1980s when interest rates were high teens and people were conducting business, right? I mean, I financed ground up multifamily, right? I mean, it worked.
Yeah. Well, so I only laugh because it just you made it sound so easy. I wish it was that easy. But what I'll say is that I personally believe that one of the problems we have at the moment, or one of the challenges, is that there's not equities on the sidelines because the risk reward doesn't make sense. And what I mean is there isn't the amount of positive leverage you would historically have in, let's say, a stabilized or minor value add deal. So we haven't reverted to the mean yet. So even if you remove all of these uncertainties tomorrow, I still think we have that challenge, right? Because there's supposedly a ton of liquidity on the sidelines right now, right? But why isn't it being deployed then? And my answer is because the risk reward doesn't make sense. Otherwise, of course, it would be deployed, right? And so whatever that risk means. So you can argue that if you take away the uncertainties, the risk is gone, I suppose. But I don't necessarily think that that's what I'm referring to. I'm talking about you're not getting enough positive leverage spread, prices are still too high, et cetera. And obviously some of the other stuff matters, but I think a lot of that matters. So I'm not sure that if you remove all the stuff you're talking about, that it will just immediately solve itself without a further adjustment in prices or at least more positive leverage.
Well, what are you seeing in terms of in the industry, commercial real estate industry? You getting
Yeah.
a sense of optimism, pessimism,
It,
disinterest? Like what's going on?
I think it depends on which side of the fence you're on. I think that I am starting to see a unified opinion or a majority opinion that more and more distress is going to come onto the market, more inventory is going to come onto the market in 26. Like the gears are going to start grinding. We're going to have more price discovery because of that, and it's going to be higher transaction volumes, which is good for some people. I think you're going to have capitulation on the seller side, or at least some banks are going to finally start, or some lenders are going to start taking back properties and moving them, which gets the industry going again. If you're a buyer, I think that's going to yield some opportunities. And I think what we're finally seeing is the beginning of the gears starting, so the engine starting, where the opportunities will surface again. How much of that will happen in 26 itself, can't say for sure. But I think the next couple of years are going to present a lot of opportunity for certain buyers, more heavy value add buyers. And then eventually that will trickle into people like me who are less heavy value add buyers, but more value buyers.
All right, let's talk about what you're looking at later, if you're okay with that, without giving any investment advice. I know you're very
Yes,
careful
I'm definitely
about
not a
that,
financial advisor, but happy to discuss that. Yeah.
you
Yeah.
and me both. So why do you think pricing is taking so long? So if you flash back to the GFC, the
Yeah.
reason I think, I mean, the kind of core reason is during the global financial crisis, banks were mandated to write their portfolios to market, right? The mark to
Yes.
market. And that forced them to book everything at below what they had them on their balance sheets for.
Yes.
This time around, there's been none of that. So
Yep.
banks are just kind of happily, well, not about happily, but cruising along with assets showing at a certain value on their balance sheets that don't have those values. That's why I think it's not real. But why do you think pricing hasn't adjusted yet?
I think that's the reason. I think there's been,
Ah,
I don't know if the word extend and pretend is really exactly accurate. There's been, extend and give me a point, extend and do this, extend and do that. And I think the extensions are just coming to a head. It's just been
mm,
too long, to your point. So I think that's finally going to catch up with everybody. And that process always takes a while. There's also bid-ask spread differences that eventually have to come together, and those take a while. It's funny. If you look at the last cycle that you're referring to, multifamily buildings really didn't get to a stabilized place, I'll call it, probably until like 12 or 13. And it took
mhm,
4 or 5 years. And so if you assume this started in 22, then 4 or 5 years of 26, 27 until we start. And so it's kind of
mm,
following a similar timeline. But
mhm.
to your point, it's a different experience because there was a lot of distress going through on a regular basis that entire time period here. It's all going to be almost like back-ended, right? And what I'm waiting to see is if this happens to coincide with the recession happening at the time, which that also is a different experience because the recession happened before a lot of the inventory trickled out in that sense, in that time period.
It's interesting to say that because so there's a few factors. Actually, I've written extensively about this as well, Jeremy, and there are a few factors that I see driving the economy. Forget the geopolitical and the election for now and all the other stuff that's just makes everything so unpredictable. But we've got more liquidity coming into the market through deregulation. You got a stock market that is at historical highs. You see silver hit $90 a blooming ounce, unbelievable. Stock market at historical highs, a real estate industry that is at cycle lows. So I love this idea of sell stock high and buy real estate low, right? So
Mm,
that's buy low, sell high. And tax breaks, like extraordinary tax breaks. So it seems like there's a confluence of circumstances that make today a particularly good time to be looking at investing in commercial real estate carefully. Would you agree with that?
I agree to an extent. I truly feel like, for those who know me, they know I've been on the sidelines for a long time. And I can truly say that this is the first year that I feel like I am staring out the window and it's 5 o'clock in the morning and the sun is just starting to light up the sky, like the first nit of light, like, light measure. And it's not quite close to being lit yet, but I can see on the horizon. It's almost like I'm going through, the light at the end of the tunnel. I'm just starting to see it, but just the first glimpse of it. But I know we're going to get there. So I do feel that there's that optimism that from a buyer perspective has been on the sidelines for a long time. That's going, that phase is going to come. So I am optimistic about that. I just think that unless you're a heavy value add investor, I don't think we're there yet because I'm not. But I think that those investors, if I was a very heavy value add investor, I'd be networking as much as possible right now. There's no doubt that those deals are starting and have already started, and frankly started last year, but now they're picking up. So this is a good time for that, to your point. And it's very interesting to think about rotating from a record PE to, or whatever indicator you want to use, into the potential trough of those value add deals.
Yeah, I mean, I guess the point I'm making is if you think that we are at 2011, right, in terms of the cycle, that would have been an incredible time to start buying because
Yeah.
then you had however long, 12 years, how long was it? 10, 12 years of constant uptick.
Yeah, and I wouldn't characterize this as 2011. I had to pick a year. I
Mm,
would say we're like either in the back half of '09 or 10 in that, like, because there was still a lot of
mm,
carnage. In '09 there was a ton of I know you remember,
mhm.
I remember, but in 10 I feel like you were starting to see that this could eventually turn around, you know? And so that's what the timing I would pick. I don't think we're quite at 11 yet. 11 is a little more advanced because by 12 or 13, everybody by then there was just a ton of people gone in and bought stuff.
Yeah, exactly. I was hyperactive working for a bank in those days. By the way, if you see me typing, I'm just typing questions, not like writing emails.
I would be impressed if you're able to do that. That would be very
Busy
impressive.
also sending emails. Okay, so let's. So what do you think? Okay, so look, you and I have been through these cycles. We've seen them. We're able to say, "Are we at 2009? Are we at 2011? Where's the market, etc., etc." There's a lot of people are brand new to this industry and have been since 2012 when general solicitation started and new sponsors entered the industry, new investors started coming into the industry. So, what would you say looking back on 25 were the mistakes that investors made that were revealed during 2025?
That's interesting. Good question. So I think the most obvious is that there's no doubt in my mind that in 25, there was a very broad sense and no denial from almost anybody that those floating rate bridge loan deals were a bad idea. That doing, and actually, I would say more importantly, because most people don't characterize it as this, is doing heavy value add at the end of a cycle is a bad idea. It's when you have the least amount of runway to actually get the deal done and other things can happen and you just can't course correct before you're off the runway. And I think the entire industry recognized that. And it's frustrating for me because I've been waiting for years for that to happen, but it finally happened. I think that most people recognize that. I think a lot of people also recognize that if you didn't make a bet on a really good sponsor in terms of execution, even an average to below average sponsor may not have been able to get through not just the interest rate increases, but the increases in costs, inflation, insurance, all kinds of these headwinds that weren't projected in these projections, then you weren't going to fare well. And that became blatantly obvious by 2025. Nobody was denying that. That's why I'm starting to feel like now that we're a year after that, I could start to see the light just a little, that we're past those phases.
It's interesting to say that. I ask people what are the lessons learned from this last cycle, both passive investors who I speak to with some frequency, as well as sponsors. And I get the same response every time, and it always perplexes me. The same response is don't take on floating rate debt. And that sounds to me like a knee-jerk reaction. It's not the real lesson. What's the
No,
real lesson?
no, and that's a really good point. And I am because I spend so much time reading economic data to try to avoid the pitfalls, it just kills me to no end that people don't understand. Like if you back up, if you were looking at a deal in 21, 2022, you have to look at, we've been in a record long economic cycle. Any move that I make today from a probability perspective has to take that into account. And Adam, what is fascinating is that
Mm.
when you're an investor, often the majority of deals you're seeing are what conform to backing into a 15% IRR projected return, just say, for example. That doesn't mean that it's actually the right move for you from a cyclical timing perspective. It just means it's what a sponsor can market to get into those returns. And that's what value add did. And that's what floating rate bridge loan did for those deals in 21, 22, 20. But you have to take a step back and say to yourself as an investor, where are we in the cycle? What makes sense now? And if you were doing that, forget floating rate. You wouldn't have done a value add deal. Again, you have to picture it like you're a plane taking off. The lowest risk time to do a heavy value add deal is at the beginning of a cycle because you have the wind at your back, rents are going up, the economy is growing, and you can course correct. And you have all this runway left and all this asphalt left before you take off. The most dangerous time is at the end of a cycle for the reasons that we discussed. And unfortunately, ironically, you get the most volume of deals catering to the heavy value add at the end of a cycle because those are the only ones that pencil to get to that 15 IRR, for example. And you have so the least amount of value add deals at the beginning of a cycle because they take the most amount of work. And so the sponsors can just buy them at better cap rates with positive leverage and it's just easier deal. But that's the time to do the value add, and that's the time to do the bridge loan, the floating rate bridge loans if you wanted to, because you've got everything at your back. So that's all economic cycle timing. It has nothing to do with, don't ever take floating rate bridge loans.
Some of our clients and some of the sponsors that I talk to, the real, what I call the elite sponsors, they've done nothing for 3 years. And you
Yes.
talk about, right, those are the guys that you want to be paying attention to, actually. As
Yes.
frustrating as it is. And get this, I spoke to a guy yesterday who, a credible guy, right? It was the first thing he told me on the phone, sponsor. He said, yeah, we've had some problems with our portfolio. And I asked him afterwards, okay, what was the mistake that you made? And the mistake that he confessed to making was, we saw momentum in the market. We saw all these guys out there buying stuff, and we wanted to do deals. We wanted to be active. We wanted to get into the game,
That's FOMO.
right? And they lost money as a result of that. And then you talk
Yeah.
to the guys that are super successful. I've just got one guy in my mind's eye I'm thinking about now who told me, he said, yeah, we sold our portfolio, I think in 22, he sold 70% of his portfolio. He said, and that because we were looking for deals, nothing made sense. Couldn't find anything that made sense. You think about the mindset, right? The getting quick because everybody else is doing it, or
Right.
the guys that are out there saying, we can't find anything that makes sense. In other words, they're being disciplined with their underwriting. And there's one fellow I was talking to said, and therefore we thought this is if we can't find anything that makes sense, now's the time to sell.
Yes.
He said, so we sold for 70% of the portfolio, and then we've been sitting on our hands for 3 years. Just now bought a couple of deals at 50% discounts to what they previously sold from institutional investors, by the way. So that's a mindset. It's so. Oh, and this fellow I spoke to, yes, that's what he said. We just wanted to get into the game. We weren't patient. How do you address? How would you advise a sponsor? What do you say to a sponsor that thinks that way?
So, it's funny because it's a different experience for a sponsor and investor during those periods. But a sponsor has got a challenge because depending on how long-standing they've been a sponsor and how well they've done, some of them are doing deals to get acquisition fees to keep the lights on, right? Because their big paydays at the end, and if they don't have enough of them that have already gone full cycle, they're not making that much in management fees often, and some of them are going to be forced to do deals, and that's a bad position to have to be in, right? So, I mean, it's hard for me to comment because everyone's going to be in a different situation. I just know you have to keep that in mind as an investor to kind of watch out for that. As an investor, though, I think you can get caught up in fear of missing out on returns. I think that's very easy to end up in. And it sounds like that's actually what happened to the GP you were talking to. And for an investor perspective, um, you just have to stay as objective and non-emotional as possible. Like I've been on many podcasts years ago, and somebody would say, "Well, someone's doing this or that. They're gonna." I would say, "Look, they're probably gonna make more money than me in the short term, so they're gonna do better than me. That's just a fact."
Mm.
But I'm also lower risk and I can sleep better, and that's all it came down to at the time, and that was the easy answer. And it is very difficult sitting in an LP. Like I didn't invest in any floating rate bridge loan deals. But over 90% of anything I saw in the pipeline for a couple of years, 20 to 22, if I want to do anything, it had to be that. I'm talking about across all asset classes.
Mm.
And it just puts you on the sideline. It's very frustrating, but you have to be disciplined. Kind of like Warren Buffett. He's just sitting on the sidelines right now. He knows the ratios are at record highs. He's got nothing to buy. And he knows in retrospect, it will be obvious he did the right thing. That's how it always is.
But you got to have courage, Jeremy. I mean, it's this FOMO. It's really tough.
I actually consider it more frustrating that I can't do anything as opposed to courage, because if you look objectively and you just stay with the numbers, it's not even courageous. It's actually the right thing to do. It just gets frustrating the longer this goes on. It takes a long time. I mean,
It does. It's funny. This whole when I say courage isn't quite the right word, but you've got to have the gumption to stick with your principles.
yes.
And in the run up to the GFC, I was out looking for deals, trying to buy, and I was developing in LA and looking for deals. And the only things that I could see were deals where I made offers, were blown out by other people, like completely blown out, and I could not figure out how can they possibly be justifying these prices. They have to be making assumptions that to me are completely unrealistic
Yeah.
on the exit.
Yeah.
And yet you can get, as some sponsors are, they get caught up in that. Do you see that very often though? I mean, is that something that you saw was it obvious to you that some sponsors were fee driven, or what do you think was behind it? Like how?
Yeah, to be honest with you, that's hard to spot necessarily, like which ones are doing it for that reason.
Mm.
But I would say that, look, again, if you're trying to be objective and you look at the fact that we had a record long economic cycle upturn, you're just saying to yourself, these sponsors are using a business plan that assumes everything's going right for 3 years and assumes that the economy is just humming along, and that's the wrong time to make those assumptions. So to me, you're taking a lot more risk than may be apparent on the piece of paper. Just if you take a step back as an investor and look at where we are in the cycle, because they're cycles and they exist and they occur. And so it's really hard to pick out at the time who's doing it for what reason. All I know is that I tell people, the more deals someone did in 2021, 22, the less likely it is I'll ever invest with them, because we just have different philosophies. And I would tell you that even if I was talking to you in 21, I'd be saying the same thing. The more deals someone did this year, the less likely it is I'll ever invest with them. And it's just philosophies. So what I would tell investors is you've got to just take a step back, create your own opinion, your own box, your own philosophy, and stick with it as much as possible. It's really important to stick with it, regardless of what you're seeing in the market. Otherwise, you can get in trouble.
Jeremy, I didn't ask you this at the beginning, and if I do ask you anything that you don't want to answer, just tell me. All
Yeah,
right,
no
that's
problem.
fine. But you're a professional investor. That's what you do for a living. Yeah.
Yeah.
Can you explain what that means exactly?
That's a good question. All it means I'm spending pretty much all my time either trying to, so I'm a full-time LP investor, which means that I'm passive, which means that I'm making a bet on other people who are executing on deals. Okay, that's the type of investor that I am. So I am doing a bunch of things at the same time. I'm always looking for opportunities, networking with sponsors, networking with investors, and networking with other investor groups. And that's all just in the whole spirit of trying to understand where we are in the space, what deals are out there, what I should be looking at. And it's in my opinion, this type of investing is all a team sport. So because as much as there is public solicitation, a lot of deals are not publicly solicited, and therefore you're still having to work to find a deal. That's the hardest part of my day, is finding opportunities.
Really? But how do you do that?
It's networking. I mean, there's many sources. You go to conferences, listen to podcasts, network with other investors, like I mentioned, all the other networking I mentioned. Now, I have an advantage because I've been doing this for, what is it now, 24 years as of next month. So I built up a network over a long period of time. So now it's easier for me to get deal flow because I have the network built. But it was just many years of building up the network to get to that point. and then it becomes easier.
So what, in 26, what would you say actually matters today? What are you looking at when you look at a sponsor, an operator, before investing with them?
Yeah, I think that a couple things. I think the number one thing that you have to keep in mind now, which is going to make it a little more challenging to vet a sponsor than it would have been in normal times, is what has a sponsor just been through? What are they going through right now? What have they been through? What were their strategies? What kind of problems are they having? And I just want to say, one thing I remember that I'll never forget from the last cycle is I remember talking to a multifamily sponsor who had one foreclosure. And it was a big sponsor and they had many properties, but the one foreclosure caused them to have a certain number of years. I forget the number. There's probably a specific number of years where every single loan they took had a higher interest rate. Just like if you got a house foreclosed, you went to try and get a loan, you're going to have a higher interest rate. That meant that every investor investing in every deal with them going forward at that time was taking on a lower return for the same amount of risk versus another sponsor, right? So there's a lot of angles you have to take on this to be able to vet a sponsor properly now. It's not as simple as it used to be if you want to really keep your risk in check and understand who you're going to make a bet on and what things may happen that you may not see, whether they're distracted by other deals. Maybe other distress isn't happening today, but it could come up in a deal they just did in a couple of years, or the deal they did 2 years ago that could come up next year. You're going to have to really dig into the sponsor and what they've been involved in the past few years, much more so than normal.
How do you advise? I know you're not an investment advisor, neither am I. We're not attorneys, accountants, anything really. We're just nobodies. But with all those provisos stated, what, how do you, again, I'm going to use the word advise, it's not advice, but how do you advise investors, passive investors who are interested in looking at real estate? What do you tell? How do you advise them to see the market make decisions in the context of what we've been talking about?
Yeah, look, if you're new to the space and you're curious about it, I would say two important things. Number one is before you do anything, please educate yourself on the economic cycle and the real estate cycle. They're
Mhm.
different in terms of what you're focused on. Get an opinion, just form an opinion based on educating yourself of where both of them stand, and then understand that when you're looking at deals, how does that fit into whether you agree or disagree with the business plan you're looking at that's presented to you. That's very important because I come across too many people who have a great story. I just sold my business. I got $10 million. I have to put it to work. I need cash flow. And my answer is always the same. Congrats. I love hearing those stories, honestly, about people succeeding. Have you formed an opinion about where we are in these cycles before you start deploying your cash? Because often people are just in this rush to deploy the cash to get cash flow. And it may be the exact wrong time, right? If that happened in January of 2008, a lot of people would tell you, oh, they shouldn't have deployed their capital at that time, right? So just in perspective. The second thing that you want to do is if you're brand new, is try to learn one asset class first. I always recommend the asset class you maybe are most familiar with to make it. So if you grew up living in mobile home parks, go look at mobile home parks. You're going to understand them better than most people. Start with that asset class. Learn that asset class, learns the revenues and expenses, assumptions, etc. You can typically transfer at least 80 or 90% of a general deals framework onto all the other asset classes and tweak for that particular asset class. But try to focus on one first because I see too many people who are looking at five different things, which I don't blame them, and then they don't quite either get around to doing anything or they don't fully learn the asset class they dipped their toe in first enough. So just focus on one, try a couple of deals in that, and then start transferring to other ones over time. So those are the two things that come to mind for people who are brand new.
Okay, so I'm just going to jump in with a comment about your $10 million friend who's sold out for 10 million, and then I'm going to ask you another question. There's a line Mark Twain. I'm going to paraphrase what Mark Twain says. It's a line that I love to hear. You said I'm so happy whenever I hear that. Mark Twain says, "Whenever a friend of mine does well, a little part of me dies."
Oh my God.
That's a
No
crazy
comment.
one. I'm
No
not sure if
comment.
it was exactly that. I know. Okay, so where do you see opportunity then emerging in 26? Is it in commercial real estate? Is it somewhere else, or should we be in bonds and insured deposits of cash?
Yep. So I'm going to state two things coming to mind immediately. One of them is
Mhm.
probably highly controversial and not something I would normally say, but I
Okay.
think there's a high probability of a Bitcoin crash coming up
Mm.
shortly. And I'm talking about like end of cycle 80% crash from the high. And so if you're into shorting things, I mean, which is very risky, that's something to look at. I might do that myself because it's
Mm,
like a once a cycle type of opportunity. I might give it a shot. The other thing that's fairly obvious to me is that there's no doubt that on the commercial real estate side, there is going to be, and there are now, value add opportunities coming up that are distressed that will present themselves that are a once in a cycle type of situation. So if you're focused on more heavy value add, you're willing to take those types of swings. Now is the time to really build up your network and try and find them, because if you wait 2, 3 years, you probably will miss a good volume of them. And that's just the way the cycles work as far as the best of the best deals. So now on the flip side, the good news is that real estate moves very slowly. So from the perspective of like, if you're more of a value investor, I'm actually worried about being too early than too late. It's that simple. I saw that in the last downturn.
mm,
And catching a falling knife when you're a value investor, you could be too early. I saw people get wiped out being too early, literally wiped out, hard money
mhm,
lenders and stuff. Whereas, so I'm not in a rush because eventually we're going to revert to the mean. I'm going to have more value deals. And that doesn't just, unlike the stock market that moves very quickly up and down, these
mhm,
real estate prices don't move it up and down crazy amounts in a year typically.
mhm,
So,
mhm.
that's one thing if you're more of a value investor, make sure you're not deploying too early and make sure you're getting the right value that you're supposed to get.
Jeremy, we are needing to wrap up. Our conversation has gone extremely quickly. So let me ask you a final question. You mentioned being a, data junkie. Well, you didn't say that, but you study data and your markets and finance all the time. So what are your
Right.
favorite sources? What sources you turn to all the time?
Yeah, absolutely. I try to do a mix of mainstream media along with non-mainstream media.
Mm,
Part of me wants to understand what's going on from a messaging perspective on the mainstream media side. The most obvious being CNBC for headlines, um,
mm,
uh, Business Insider. You know, it's
mm,
funny, Business Insider. I don't know if somebody bought them a few years ago. I used to
mm.
read them every day, and then all of a sudden, all the headlines were all political, and I'm not a political kind of guy at all. I don't even vote. So then I stopped, and now I just started recently. And what they do is they show the economic headlines first, and then they have the political stuff, but it's further down. So that's more tolerable and easy to read now. So that's another good mainstream to get a sense, right? I also use a Google feed, which I think my Android
Ah,
phone is doing automatically for me based on what I've read. And so that's also tapping into a whole bunch of mainstream sources randomly, which is really nice.
mm,
The non-mainstream stuff depends what you're trying to find. My favorite non-mainstream source that's really objective is calculatedriskblog.com. Um,
mm,
and they actually look at a lot of data that a lot of the mainstream media does not look at, whether it's trucking volumes. God, there's so many things. One thing I really love about them is they produce their own charts. And so they have a little commentary, but generally speaking, the charts, you could just look at them and they speak for themselves and that they're objective and they create them from years before. So that's extremely helpful. I definitely recommend that one.
mm.
Another one that I like, but it's become more political. So it's kind of bothering me now because the headlines are now more political than economic. But I really like Zero Hedge as far as like if a jobs report comes out, you can go on there and they will slice and dice a jobs report to get to the bottom of what's actually happening versus what the headlines are saying on the mainstream media side. So that's a good source for that, as long as you can get through the more political stuff on there.
Yeah.
And anyway, those are some of my favorites on the both sides of the fence.
Okay, they are completely different from mine, which is good actually, right?
Well,
I,
what are yours? What are yours for
yeah,
data? Like the non-mainstream data. What are yours for that?
I actually I subscribe to a lot of newsletters. I like newsletters. Some of them are very insightful. But you say non-mainstream. I'm a huge fan of the Financial Times. I think
Mm,
their analytics, their correspondents, their journalists are extremely knowledgeable. Their podcasts are really good. They're very insightful, highly analytical. And what I particularly like about it is that it isn't apolitical.
mm,
They're not, they're not, they're overseas, right? They're looking in. They're not here subject to whatever kind of wacky pressures that there are these days on media organizations here.
right.
So I find the coverage very good. And they also have a really good set of podcasts that I like to follow
That's
as
good to
well.
know. It's funny. My Android feed actually, Financial Times is. I'm typically seeing probably 2 to 4 of stories from them a day in my
Mm.
in my Google Android feed, which is nice.
Yeah, that would suggest it's a good feed. Yeah, so that's what I do, and I also set up a task in ChatGPT that gives me weekly updates on credible sources for what's going on a macroeconomic level, anything major going on macroeconomically. And so I actually get a notification by email from that every week as well.
I didn't know that ChatGPT could do that. So it can set up almost like an alert, like a Google. I have
Yeah.
alerts. I have Google alerts based on certain keywords, but you're saying you can actually set up a recurring task. Monday
Yes.
at 9 a.m., send me the top 10 headlines from the past week in my inbox
Yeah,
twice a week.
whatever prompt you want to put in.
Oh,
Yeah, I
that's
ask for
awesome.
commentary and insights. It's not perfect. It tends to repeat the same things. And I say for the last week, all I want is news from the last, like the ultimate update.
Hmm.
And it sends me those, and it's good. It's a quick look, it's a quick glance, has all the links, so you can drill down on it as well.
It's a great idea. I've never heard anyone say or recommend that, but
A
it's a great idea.
task. Yeah,
Yeah.
it's a ChatGPT task, but they keep changing things, Jeremy, on ChatGPT. So I'm not sure how to find setting up a task again. So you maybe just ask, how do I set up a task? And it'll show you how to do that. And get
Okay.
email alerts, but they do work well. Anyway, let's wrap up. Jeremy Roll of the Roll Investment Group. It's always a pleasure to see you. Thanks for joining me today.
Thank you for having me. I really appreciate it. I just want to wish everyone good luck for 26. It's going to be an interesting year for sure. And good luck with your investing.
All right, that was Jeremy Roll of the Roll Investment Group. Jeremy, always good to see you. I know that you and I normally talk by phone, so it was good to see you actually today and to have such an interesting conversation as we always do. So thanks for joining me. Thanks for your time. And thank you to dear viewers and listeners. Appreciate you spending your time with me today and with Jeremy. Please, if you've not, or actually, you know what? I was going to say sign up to my newsletter, but instead, if you're not already connected with me on LinkedIn, go ahead and connect there. I'm easy to find. Adam Gower, Gower Crowd should pull me up fairly quickly. And I write a lot on LinkedIn. I enjoy the process of writing on LinkedIn and posting on LinkedIn. I find it creative and interesting. And there's a lot of very interesting people there that you can engage with in informative dialogue, right? It's not face chat. It's LinkedIn. So it's what I call business casual media, not social media. So if we're not connected on LinkedIn, please go ahead and connect with me there. Okay, that is all I have for this first episode of the new year. Thanks for joining me again. Thanks, Jeremy. And until next time, this is Adam Gower signing off.